and online. We're happy to have you and appreciate you joining us. Today we are going to be talking about the capitalizing on the advantages of note investing. So let's dive right into it. Disclaimer, as always, we just serve as the custodian. We are not a financial advisor. We do not provide legal advice or sell investments. We just custody the IRAs and allow you to tell us where you want your money to go. So what is a self-directed retirement plan? A self-directed retirement plan is just a retirement plan in which you self-direct or tell us where you want your investments to go. Self-direction is just a marketing term, but an IRA is an IRA. So what are the benefits of self-direction? So diversification of your portfolio. You're able to invest in a wide variety of things inside of the portfolio. Some people, are invested in stocks, bonds, and mutual funds at maybe Charles Schwab, TD, or something, and then have an account over here with us where they're able to invest in real estate, notes, or anything else. For the other benefit of self-direction, which is the tax savings that you get inside of a retirement account, whether that be tax deferred or tax-free growth. So obviously investing in what you know best. 9 times out of 10 when people are invested in the stock market, they don't even know what they're investing into. So why not take your retirement funds and invest in a market that you know that you can do the due diligence on, that you fully understand, so you know what return you're expected to get on these types of investments. So what are notes? Notes are debt instruments or promissory notes, written agreements between a borrower and a lender. The borrower promises to repay a specific amount of money, and the repayment is made within a defined time frame, and interest is often added to that repayment amount as an incentive for them to loan the money. So how does it work? Number 1, a borrower will require funds and seeks a loan from a lender. So for example, a lot of times what I see is real estate investors who can't get any more money from a bank, or they've utilized all their hard money and they can no longer access any of that, but they're still looking to do deals. So that's when they can come to an agreement with an investor or somebody who has money in their IRA, somebody like you, where you guys can negotiate the terms of the loan. The coolest thing about these types of things is you become the bank, so whatever you guys agree upon will be, set in stone for the entire investment, and they're promised to pay you back on those terms. So promissory note, once the terms are agreed upon, a promissory note is created, and it outlines all of the details of the loan. Repayment, the borrower will make regular payments to the lender over the agreed upon term, typically include both principal and interest. The interest rate is compensation for the lender's risk and serves as an incentive to lend their money. Interest can be fixed or variable. Maturity, this is the maturity date that you can set, a specific maturity date when the full loan should be repaid. It can range from several months to several years. And default, if the borrower fails to repay you or make the required payments on time, or breaches any of the other terms. Remedies, lenders may have remedies such as foreclosure or legal action. So say, for example, using that example that we used with a real estate investor, they're looking for $50,000 for their real estate deal. You, the IRA owner, are able to loan that $50,000 at whatever interest rate that you guys agree upon, and you can either do this secured or unsecured, meaning that if it is secured, you can collateralize the loan in the example that we used by the property. So if the borrower defaulted on the loan, you could hire a company to foreclose on that property, and at that point you would become the owner of the property. So note investing entails buying and overseeing debt instruments. Investors can earn returns through various means: regular interest payments, potential appreciation in the note's value, or acquiring distressed or non-performing notes and resolving the issue with the borrower. So the benefits of note investing would be steady cash flow. They provide a consistent income stream Of course, in the IRA, it would be a consistent income stream back to your IRA. Diversification, so independent of stock market performance. So it doesn't matter the volatility of the stock market, whether that's going up and down, that note is diversified out of the stock market. So it doesn't matter how the stock market is doing, that note can still perform. Collateral, additional layers of protection. So as we were mentioning, the secured part or unsecured, always add that layer of protection, and of course, do what you feel is right with the borrower, but make sure that you're securing it if you can, or collateralizing it by something that you would want to own. So for potential for high returns, you can negotiate the terms, set interest rates, agree on repayment schedule, and then you have the control. So you can negotiate the terms, set the interest rates, and agree upon the repayment schedule when you want them to pay you back. You become the bank. So risks of note investing: default risk, which would mean the borrower doesn't pay you back; market risk, losses due to fluctuations in the market; interest rate risk, so market increase could mean loss of value for the note; lack of liquidity, sometimes the note is not easily bought or sold, so it'll be hard to get out of that note; due diligence, assess market risks; legal and regulatory risks, there could be a change in the law which would change the structure, impact the terms, or the taxation. Of course, it's always important for investors to carefully consider these benefits and risks and conduct due diligence, and we of course recommend seeking professional help to review these notes and making sure that before you engage in the note investing. So using an IRA for note investing. Using an individual retirement account for note investing can offer several advantages, which would be, of course, the tax benefits, whether that be out of a traditional or a Roth IRA, meaning that that's either all tax deferred growth or tax-free growth, depending on which type of account that you invest in the note in. Contributions to a traditional IRA are tax deductible, so any earnings within that IRA are tax deferred until you withdraw them. And the opposite for the Roth. Contributions to a Roth IRA are not tax deductible. You pay the tax on the money going in or on the contributions. And then any earnings within the Roth IRA is completely tax-free. Using an IRA for note investing for asset protection. Assets in the IRA might be protected from creditors. So in the event of bankruptcy or creditors, you will be protected inside of the IRA in most cases. Diversification, potentially reduce risk and increase retirement portfolio stability. As we mentioned, being invested in a wide variety of different asset classes, so you can limit the risk. Long-term growth, notes can generate income and eventually grow your retirement. I know just last week I was at the OREA, which is the Ohio Real Estate Investor Association conference, and I was speaking to one of the members there, and she told me that all she does is note vesting. She started off at a small $100,000, and now she's all the way up, I think to, I want to say $500,000, and all she does is note investments. And now, since she has so much years experience of being a note investor, now she doesn't charge anything under than 18%. So she's charging 18% every time she loans out her money. She says they're usually about 6-month terms. So, I mean, that's a pretty good return, I would say. And estate planning. So you can facilitate the transfer of your note investments to your loved ones in your passing. There, of course, are rules and regulations regarding investing in notes through your IRA. So consult with a financial specialist to help you understand specific advantages and considerations for your individual circumstances. So the types of plans that are able to invest in notes is every IRA that we hold here, even educational savings accounts, 401k plans, and HSA. So with the traditional and Roth IRA, these are also all the contribution limits here for the different types of plans. If you'd like to go into what type of plans would be best for you, just please contact our office and we'll be happy to go over the specifics for each different type of plan. And restrictions on IRAs. Restrictions on IRAs are as normal. There are people restrictions or prohibited parties, which would include any of your ascending or descending family members, along with any of their spouses, your fiduciary, your tax advisor. Those would all be considered prohibited. Transaction restrictions. This would be doing commingling of funds, the same rules as always inside of the IRA, no matter what your investments are and your investment restrictions, no loaning to yourself, no providing services or getting any benefit from the IRA other than the tax advantages. So here is a picture of all of the prohibited parties. If you want to take a picture of this would be people that you would not be able to go into business with, loan your funds to, live, work, or stay on your property, loan money to, etc. Give a note to, buy a note from. These would all be prohibited. Transaction restrictions. You cannot buy, sell, trade, loan, or extend services to your IRA directly or indirectly, as well as any of those prohibited parties. Investment restrictions. The IRS allows you to invest in a wide variety of asset classes. Most things are on the table to invest in. Two things that are not on the table are life insurance and collectibles. If you're investing in life insurance, it's kind of like investing in your debt, which kind of defeats the purpose of investing in your retirement. And collectibles you're not allowed to invest in because the value is subject to from person to person, so there's no set in stone price or value of what that collectible would be. So real estate notes. Real estate notes, also called mortgage notes or trust deeds, involve investing in real estate related debt. Investment options include buying existing mortgage notes from banks or individuals, originating loans secured by real estate. Note investors can earn income through interest from the borrower's monthly payments or profit from selling the note. Business notes. Business notes involve investing in a small business or startup's debt. Investment methods include direct loans to the business, purchasing existing business notes from the lenders. Business notes may offer potentially higher returns, and they also carry higher risk compared to real estate notes, because when you're investing in a business, as opposed to investing in a piece of property or a note that is collateralized by the property, as we mentioned before, if the borrower defaulted on the loan, you would foreclose on their property and own the property. When you're investing in a business note, you're kind of investing in the business in the hopes that their business is going to be successful and be bringing capital in. I'm sure there's something that you can collateralize it by. I'm not entirely sure, but it wouldn't like you would own the property like in a collateralized loan of the real estate. Consumer notes. Consumer notes involve debt instruments tied to consumer loans like personal, student, or auto loans. Investors can acquire consumer notes from lenders, peer-to-peer lending platforms, and these notes offer various risk levels and returns based on the borrower's credit worthiness. I know something, for example, that people like to invest in a lot is tax liens. So at the end of the year, whenever you own property, you owe taxes at the end of the year. Sometimes they can be $4,000, $5,000, and maybe up or below, depending on the value of the property, obviously. And some people don't have, that $4,000 to $5,000 to pay right then and there, which at that point you would be able to say, hey, I have $5,000. I'll go ahead and pay off this $5,000 of taxes for you at 12%. I'll pay it off and then you pay me back in X amount of time. And if you don't pay me back or you default on the loan, I'll foreclose on the property and you own the property. So even though you even only went in at an investment price of $4,000 to $5,000 to buy the tax lien or the note, and then they didn't pay you back, you end up owning the property, which could potentially be a much higher interest for your investment. So performing versus non-performing notes. Performing notes. Borrower makes regular, timely payments. These are good standing notes and good borrowers. Non-performing notes would mean when the borrower has fallen behind or defaulted on any of the payments. They may offer higher returns but require more effort to resolve the delinquency or foreclosure. Investors can invest in both performing and non-performing notes. Secured versus unsecured. This was the biggest thing that we were talking about at the beginning of this class. Secured is backed by collateral, like real estate or assets, providing added investor protection. So, if, say for example, that we were talking about earlier, where that real estate investor is looking for $50,000, and say you don't know this guy and you have the option to do a secured or unsecured note, and you choose unsecured, that means that the note is secured by nothing. You're going based off the borrower's word that they're going to pay you back, rather than them saying, oh, I need a loan $50,000, and if I don't pay you back, you can foreclose on the property and own the property. So distressed debt investing involves buying notes or debts at a substantial discount. Typically occurs when the borrower is facing financial distress. This strategy allows for investors to profit from the recovery or resolution of the distressed debt. So evaluating notes for risk factors. You're first going to want to assess the borrower. As we mentioned before, you're going to be somewhat relying on this person's word to pay you back, even if you do have a secured note. So you're going to want to assess the borrower, make sure it's somebody that you want to loan your money to. Review the collateral. Make sure that whatever you're collateralizing this loan with, you're going to want to own what you're collateralizing with, just in the event that they did default on the loan and you did end up owning this, whatever you collateralized the loan or the mortgage or the note by, you would end up as the owner. So make sure it's something that you would want to own. Analyze the terms and conditions. So, when you're building this note, when you're becoming the bank, it's all about your terms and how you and the borrower agree upon these. We always recommend that you guys meet with a financial advisor or attorney to draw up the note. I know there's note templates online, but always try to meet with an attorney if you can. They have the special skill set and licenses to be able to review these types of investments and make sure that both parties are in good standing. Assess market conditions. So of course, like with inflation right now, if somebody wanted to borrow money from you, do you think it'd be super smart to be loaning out your money at a 4% interest rate? Probably not, because that's not what the market is these days. Perform due diligence. Make sure that you do your due diligence on the person, the investment, and make sure that if you're loaning out $50,000 for a real estate deal, that you know that this real estate deal is going to be worth that $50,000 plus more for what they can pay you back, plus making interest for themselves. So of course, doing the due diligence on that. Evaluate the risk factors. Always be prepared for the worst. Calculate potential returns. You're going to want to make sure that you know what you're getting from this type of investment to know that this investment is worth your time. And seek expert advice. As always, always seek professional help. Strategies for sourcing and analyzing opportunities. So investing with your IRA, tax implications. UBIT is a tax imposed by income generated from activities that are not directly related to their tax-exempt purpose. The purpose behind UBIT is to prevent tax-exempt organizations from having an unfair advantage over regular taxable businesses. UBIT is unrelated business income tax that you would get from having say for example, you invest in a business and the income generated from the business is what's paying you back and generating that interest. At that point, that would enact UBIT. So for example, if an IRA invests in a note where the borrower operates in a business and the income generated is attributable to that business, it may trigger UBIT. Risk management and diversification. Assess the borrower credit worthiness. Make sure they are who they say they are. Do your due diligence on them. Maybe background check. Collateral evaluation, as we mentioned before. Make sure that whatever you're collateralizing this with, and just in case they were to ever default on the loan, you would become the owner, so make sure that you know what you're getting. Diversify across your notes. So we mentioned a bunch of different notes that you're able to invest in. Make sure that you diversify even the notes that you're investing into to limit the risk and up the return. So consider geographic diversification, whether that be an investment here. You're able to make, I don't know if most people know this, but you're able to invest in notes even outside of the country if you're looking to do so. Of course, the same thing as always, do your due diligence and speak to a professional. Make sure that this is something that you truly want to do, but you do have the option. Regularly monitor performance, so make sure that you're getting your payments on time. Make sure that everything's going the way that it's supposed to be. Maintain adequate reserves, so just in case. Always have cash in your back pocket, just in case you ever need it, and stay informed. So make sure that whoever the borrower is keeping you in the loop with whatever's going on with the investment, because you deserve to know when you're using your money, loaning your money for an investment. So once you have reached an agreement with the borrower, have your documents drawn up by your legal counsel, paid by from your IRA or from the borrower. What a lot of people do is they'll have to meet with the legal counsel and they'll say, oh, you're looking for $50,000. I'm going to charge you $52,000 because I'm going to include the prices to meet with an attorney to review this note inside of the price. So that way the borrower is paying those fees and not you as the lender. Suggest that you include a clause to have borrowers pay new views fees. So the same thing as the legal fees, you can do the same thing where you can include your new view fees in with the note. So that way the lender is paying your new view fees and you're not. Again, the note is all on your terms. You become the bank. So if you say, I want you to pay the legal fees and I want you to pay my new view fees, and then I'll loan you this money, that's up to you. And then you can collateralize it by, if it's a property, collateralize it by their property. If they default on the loan, you own the property. And you got all your legal fees paid for by the lender. So monitor payments made on the New View portal. You'll be able to view all the payments that come in monthly and make sure that you are getting paid in your client portal. So if there's any lates, initiate a late notice and initiate collection notices if required. Also paid for by the IRA. Remember, anything you pay, any investment or anything done inside of the IRA account has to be flown to and from the IRA account and paid for by the IRA account. So the investment, as well as any expenses that are needed for the investment, will need to be in the IRA in order to make these types of investments. So foreclose as required. As we mentioned, if they default on your loan, go ahead and foreclose on their property, foreclose when you're supposed to. Use a third party, of course, paid for by the IRA. Hire somebody to get this done for you, and at that point, then you would own whatever you collateralized the loan by. If you did a secured note, if you did unsecured, you would just have to consider that a loss, and nobody wants that. Once the loan is paid, initiate the payoff notice signed by New View IRA, and then this will satisfy the note. Things to consider. So as we mentioned, do not loan if you would not want to own. Whatever you're loaning for, make sure that you're going to want to own what you're collateralizing that loan for, just in case of the event they did default on the loan, because at that point you become the owner and you're kind of stuck with that investment until you do something with it. So pay for the repairs after they are done and inspect. Do not loan unless you are willing to foreclose. If the loan does go into default, act now, not later. This is your money. This is your investment, your retirement that people are playing with. Collect interest monthly. Make sure that they're making their payments on time. If you're unsure about a loan, hire a professional. This is like our favorite thing to say, to meet with a professional. They are honestly the best resource to make sure that you're getting what you deserve and making sure that you're doing what you're supposed to be. Get title insurance for your loan. So you are able to get title insurance for your loans, and verify hazard, and if necessary, flood insurance is in place for naming the lender as the insured. Insist on evidence that property taxes are paid whenever they become due, and get a personal guarantee if lending to an entity. A personal guarantee is a legal thing. So here's what to do next if you're interested in investing with your IRA into notes. Please scan the QR code and speak to one of our IRA specialists. We are always on standby, waiting for people to call. We're happy to get on the call, answer any questions that anybody has. And let's move on to questions. Are there any questions today?
There are a couple online. The first one from online was, can I use my existing IRA to invest in notes, or do I need to set up a separate self-directed IRA?
Yeah, so if you have a self-directed IRA, at a self-directed IRA custodian that allows you to custody notes, then you would be able to utilize that IRA that you have. If you're, say, at a Charles Schwab, TD, or Fidelity, you would not be able to invest in notes with those IRA accounts. So you would need to set up a self-directed IRA account at that point and transfer over some funds and get that rolling over here with us, because you wouldn't be able to with them.
Another question from online is, can I invest in foreign notes with my IRA?
Yes, you can invest in foreign notes. Just, of course, meet with the accountant or attorney and make sure that you know what you're getting into and that you know all the terms and agreements inside of that, because especially make sure that you can read it and you understand it.
Okay. And then the last one from online are, what are the implications of holding notes to maturity versus trading them actively within an IRA, and how does this impact tax treatment and overall investment strategy?
Can you ask the first part again?
Yeah. The first part was, what are the implications of holding notes to maturity versus trading them actively within an IRA?
So holding notes to maturity would give you that steady passive income stream. You know what you're getting every month. It's set in stone that what you guys agreed upon. They're paying you at a certain date every month, and you are expecting that every month, and it's cash flowing to the IRA every single month, as opposed to buying and trading it. There is some people like selling and trading notes, right? Just like a stock or a bond. Some people like buying and selling and trading them because they understand that if they sell them, they can change the interest rate or change the terms and maybe get higher capital and grow quicker. But it's not as set in stone. And the tax implications would be the same. If it's, in a traditional IRA, all tax deferred growth, so it wouldn't matter. You wouldn't be taxed at any point until you take the money out of the IRA account as a personal distribution, as opposed to the opposite for the Roth. If you invest in the Roth, any growth inside of that is completely tax-free. And even when you take it out as a personal distribution, it's also tax-free.
All right, that was everything from online.
Perfect. Well, thank you guys so much for joining. Of course, please stay up to date with New View on all of our socials. We enjoy having you guys, and stay on the lookout. We have an exciting new, not really new, it's just something that we do annually, which is our investor retreat, where we'll put on a conference downtown Orlando. We're shooting for 300 to 400 people. Get our clients and get our inspiring clients and people that know Newview referral partners, all together in one room for a night of networking and learning. I'm super excited about it, and I hope to see you guys there.